What's the key driver for markets here? My next Money Show MoneyMasters podcast guest would say it's the action in bonds. Yes, many investors expected Moody's would eventually get around to downgrading the US's AAA credit rating, and of course, it did last Friday. But trading activity in US and global bond markets, including the test of key Treasury yield levels here at home, suggests worries are increasing. Worries about government debt, worries about budget deficits, not to mention the ongoing tariff saga and the potential inflationary impact it might have. That's why I'm so excited to be joined by Victoria Fernandez. She's Chief Market Strategist at Crossmark Global Investments, a fixed income specialist with decades of experience in the market, and another all-new guest here on the Money Show podcast. Welcome to the podcast, Victoria. Well, Victoria, thank you so much for joining me. I haven't had the pleasure of having you on the podcast before, so I was wondering if you could start by talking a little bit about your background in the markets and what your role is there at Crossmark.
Absolutely. First, it's a pleasure to be here. Thanks for having me. And my background, really, I'm born and raised in Houston, and I went to school here, and I started my career here, and I continue to be here. So, really, a Texas bred girl for sure. I began my career working in the fixed income division at a privately held money manager here in Houston via Seraphim and Company. I was there. I always hate to use years because people can start adding up what my age is, but about 20 years I spent there at that firm doing everything in the fixed income area from research to trading to portfolio management, and ended my career there as part of their principals and associates team. I'm helping with some of the management of the firm, but really as it relates to the fixed income side of the business. And I left there in 2012 and moved over to Crossmark. At the time, we were called Capstone. We did go through a name change, so we are Crossmark Global Investments. And I've been here running the fixed income division for the last 13 years. In addition, because as you know, in many firms, we wear multiple hats. So I do run the fixed income division. I serve as the portfolio manager for taxable fixed income strategies, but also serve as our chief market strategist. So work very closely with our CEO and CIO, Bob Dahl, and other members of the investment team to really kind of set our outlook and what we see going forward in the markets and how we want to position our clients for that.
Perfect. Well, I appreciate some of that background. I think it sort of flows well into what I'm going to talk about here, and that's the fixed income markets. I mean, I think the big news story, it's obviously what Moody's did late on this past Friday. What are your thoughts on that downgrade and in terms of what it might mean in either the short term and the long term?
Yeah, it's interesting. The bond market really is kind of driving the equity markets as well right now. And when we look at that downgrade that happened, I was actually watching all weekend long, waiting to see some large reaction in yields, and I didn't get it to the extent that I thought we would. And then I had to sit back and go, well, look, this is the third rating agency to do this, right? It's been a very long time. We had S&P, we had Fitch. Moody's is finally coming to the party. So maybe it wasn't a huge surprise to a lot of investors or to the marketplace in general. And the items that they mentioned for the downgrade, these are items that we've all been talking about forever. Interest expense. I mean, how many times have we talked about interest expense? Once it gets over 14% of revenues, austerity should kick in, and we're at like 18% now. So we've been talking about that for a while. We talked about it at the Money Show in Dallas with people there. And so I don't think it was as large of a surprise. We know we have a deficit issue. We know Congress is working on the tax bill. So all of this has been really kind of front of mind. And I have a feeling that maybe that was part of the reason that we didn't see even a larger move in yields. Now, yields did move up. We had kind of a parallel shift on the curve. So yields moved up across the curve. But I don't think it was all because of the Moody's element. I think there's probably some inflation expectations that are getting higher. We've seen that with University of Michigan. We've seen it with the New York Fed numbers. So I think you add the downgrade along with inflation expectations, concern around growth, and you're going to get higher yields. And that's not just here, right? We're seeing it globally as well.
Yeah, I'm glad you mentioned that. I mean, it's kind of interesting. When you spoke in Dallas, it was right amidst this sort of equity market volatility storm. Now as we're speaking, 30s are sort of testing that 5% level again. Yield 10s are back above 4.5%, give or take. Do you think we're going to see more of this kind of bond market volatility, if not related to the downgrade, which, as you mentioned, was kind of anticipated, but the bigger picture issues, debts, deficits, inflation, and so on?
Absolutely, I think we will. I mean, those bond vigilantes are kind of waiting there in the wings, right? I think they are ready to make their voice be heard if they're seeing things that they don't like. And perhaps, again, that's part of the move that we've seen. But we could be kind of in a consolidation phase here and not a tight range, but a larger range for yields. So let's just talk about 10-year yields. I mean, we are at a 450 this morning. So are we going to be in a range of maybe 4.25 to 460 to 4.25 to 475 for the foreseeable future? I think we could be. And as you know, some of the moves that we've seen in yields over the past 18 months or so, I mean, we could go 50, 75 basis points in a very short period of time. I'm not saying that that can't happen, but I
Yeah.
have a feeling that the bond market has priced in a lot of the uncertainty that we have there. And so we'll probably move back and forth, but I'm thinking our range is going to be maybe 50 basis points total. So maybe you get 10, 15 basis points of movement instead of that 50, 75 that we've been seeing. But the volatility is going to be there until we, I think, get through a lot of the policy uncertainty, the monetary uncertainty. There's just a lot going on out there, and we need some answers on that before I think people feel confident to put their money to work. Although I will say, at a 450 on a 10-year and a 5% on a 30-year, it's a little advantageous for someone to go in and start locking in some of that income as yields probably will move lower over the next 12 months.
You mentioned the U word, uncertainty. It's kind of interesting. One of your previous appearances on TV the other day was talking about the dichotomy between hard and soft data,
Yeah.
uncertainty being cited, but people still spending, job market still being okay. What are your thoughts on how that all shakes out? I mean, are we going to see this big transition from soft data being weak into hard data being weak, or do you think it's, more of a tempest in a teapot?
Yeah, you would expect that that soft data would flow through to hard data. Soft data is more kind of about expectations and what people are think is going to happen. Hard data is more kind of the confirmation of that. So it usually starts in the soft data and then bleeds into hard data. And when it hits that hard data, that's when the Fed starts to take action. That's when they see it in their numbers that they've been waiting for. How long have we heard they're data dependent? They're waiting on that. But I find it interesting that we are not seeing that flow through as quickly as I would have expected. The
Yeah.
soft data has been really weak. And I actually think the labor market is probably weaker when you look at some of the underlying trends than what we're seeing in the hard data. And so the question is, how does that flow through? Is it not doing it because there was such a pull forward, right, prior to tariffs? So I can sit there and say in a survey to you in soft data, I'm very concerned about inflation, right? I'm concerned that I could get laid off if growth really comes down, if profit margins get squeezed at corporations, I could get laid off. But yet my actions could say, wait a minute, I need to buy this item and it's probably going to be 15 to 20% higher 6 months from now. Let me go ahead and buy it now. So actions and words have not aligned. I would assume at some point that's going to happen. And maybe it's a little give on both sides. Maybe it's not completely flow through to hard data. Maybe soft data gets a little better and hard data starts to weaken and they kind of meet in the middle.
Okay, fair enough. Let's shift to equities here. I mean, we've had the big sell-off, big rally, and now we're kind of chopping around a little bit, trying to figure out what's going to happen next. What are your thoughts on that score? I mean, where does the market go from here? Any sectors that you think are a good way to play, in the next few months, next couple of quarters?
I have to say, and I am a bond girl, right? So I kind of lean towards the more cautious, more conservative nature of most investors. But it does make me a little wary when I look at how quickly we came back from those lows that we saw back in April. I mean, it was such a quick move back that I feel like we've got to have some consolidation, and maybe we're starting to have that Right now, the S&P keeps bumping up, against some of its resistance levels. So
Yeah.
maybe we're going to start to consolidate a little bit here. I would look at sectors that have been in uptrends, even during all the volatility that we have seen. So I know some of these names have had pullbacks, but their uptrends remain. So you look at financials, they continue to do well. So maybe, dive in a little bit, look for certain names as they pull back in the market that you can add. Industrials have actually started to make some relative highs. So they're starting to perform better. So that's a positive sign. Unfortunately, being in Houston, the energy sector has just been continually weak. They're in a
Yeah.
downtrend. So it makes it, a lot of people say, well, you step in and buy the dip when they come down automatically, but you don't want to buy a dip when they're in a downtrend, right? So we'd still be a little bit cautious there, but utilities continue to do well also. So you're looking at things like that, industrials, some utilities, some financials. I think you can find some names there to do well. But I'm just not seeing enough evidence in the internal momentum of the market on a sustained basis to
Hmm.
tell me that we're just going to go up and to the right. From here, I think we'll continue to have some of this churning for at least the next few months.
Got it. And thoughts on fixed income positioning? I mean, if you're sitting down with someone and kind of talking about what parts of the fixed income market look, attractive or as coping strategies, what would you suggest there?
Yeah, so we've actually really liked the treasuries as of late, mostly because there is the anticipation that the Fed will cut rates. Now, we've said there's probably just one or two cuts this year, because, it's going to take a little bit for some of the elements of the tariffs and things to flow through, but we'll probably get more cuts next year. So you
Hmm.
could position yourself for some cuts on the shorter end of the curve, and yields are nice and attractive there. And then we would barbell out to the longer end of the curve and lock in some rates like we were talking about. You can get some nice investment grade corporates. We don't like to go into high yield too often, especially if we're concerned about growth going forward. So we would stick with investment grade. They've widened out some this year. There's been a little bit of tightening, but they're still wider than where they were, at the beginning of the year. So you can go in and pick up some investment grade corporates, pick up some treasuries, and we would do kind of the short end and the longer end of the curve. The belly of the curve, that kind of 5-year mark, has been a little expensive. That can change, obviously, but that's how we're positioning for our clients.
Got it. Perfect. And, within the equity space, you mentioned a couple sectors. Are you comfortable with naming a name or two of individual stocks, or would you rather stick with sectors?
No, we can talk a little bit about names, and I think when you look at financials, Goldman Sachs is a name that we have really liked. We anticipate that as you have kind of the deregulation elements from this administration, as we get the tax bill going through, we're assuming these things are going to happen, coupled with tariffs. It was always kind of a broader picture of what we were looking at.
Yeah.
That you're going to get some positive movements. You're going to get some M&A activity going on, and Goldman would benefit from that. And so Goldman, we think, is a great name in the financial space. And we also like, even though tech has not been in a solid uptrend, a name like a Cisco has actually been doing really well individually, and you're not paying too high of a price for it. They're changing the way that they do a lot of their business, and some of their revenue now is coming more from software and
Okay.
elements and services that they have. So I think you can kind of eliminate some of the volatility of the Mag 7 that you see and find another tech name. And so Cisco would be a good name that we would like as well.
Perfect. Great. Victoria, you're going to be speaking at our Las Vegas event in July. Obviously it's far out, so we kind of have to name these topics ahead of time, but yours is going to be fewer tailwinds and more tail risks. If somebody attends that event, what are some of the things you think you're going to talk about? What are these tail risks? What are a couple things people need to be aware of as we roll into the back half of the year?
Yeah, so we've mentioned a few of them already, and we'll dive a little bit deeper. And I do have to say a caveat. Obviously, when it comes to July, that title could change, right? Depending on what's happened going on. But
Absolutely.
some of the tail risks that we have been saying, I talked about the weakness of the labor market and how we think it's probably weaker than what some people are seeing. So we think that's an issue. on when it comes to tariffs, I am of the camp that, look, we are only in a 90-day pause. I am by no means confident that we hit the 90 days. Remember, there's two separate 90-day pauses that we're in, right? I'm not under the impression that that is just going to hit 90 days and everything is going to be great. We could see tariffs go right back up again. So there's a concern there. And I also have concerns around China, not just the tariffs, but I think some of maybe the Middle East action that we have seen over the past few days in deals when President Trump was there could be setting it up for the administration to go back and take a harder stance on China once again. So those are just a few of the things that I think could be tail risks along, excuse me, with geopolitical events. Obviously, there's a lot of that as well. So those are a few of them. There's more that we'll discuss in Las Vegas. So hopefully everyone will sign up and come join us.
Perfect. Absolutely. Victoria, I want to thank you so much for joining me for this session. Viewers, if you're watching this and you want to learn more from Victoria, she is going to be joining us for the first time in Vegas, the Money Show Masters Symposium. It runs July 15th to 17th, and we're at an all-new venue this year in 25, Caesar's Palace. Check out the details in the description below, and you can click the link to register. Victoria, thank you again so much for your time.
My pleasure. Thanks for having me.